Hello everyone and welcome to our February edition of our investment market update. Today I'm joined again by Phoebe Stone from LGT Wealth Management. Hi Phoebe.
Hello.
Hi, yeah, thanks for coming back on. I think it was July last time you were with us, so been a little while, and hopefully today you'll have some better news for us than we had when we last had our conversation in July about the markets. So as ever, I'll pass over to you to bring up your slides, and if we can start going through those, and then I'll interject if there's any questions as we go. Hope that's okay.
Yes, absolutely. Let me just grab the slides. So you asked me to give a bit of a background to the year last year, and I think that's a really important place to start because 2022 was certainly pretty historic when we're looking at the outcomes of financial markets. And these two charts really bring that point home. It wasn't just difficult for equity markets, and certainly we saw pretty significant drawdowns in the majority of markets across the world last year. But also, and this is really where the sort of history element comes in, there was a significant drawdown in fixed income markets and bond markets. The chart here on the left on the screen really puts that into perspective. The individual dots are years, and it plots the return, positive and negative, on each axis of bonds and of equities in each of those years. If we look at 2008, as we know, one of the biggest drawdowns in recent times for equities, we saw that drawdown of over 40%. But importantly, fixed income bonds, which are usually the ballast in a portfolio, produce positive return. And that's really where this year was quite so shockingly different to any other years. Really a 1 in 100 year situation for fixed income assets. The falls there negative for fixed income bonds and for equities at the same time. So for what we call multi-asset investors that are looking to allocate to equities and bonds as two different asset classes, it was a very, very difficult year. This is also shown on the right-hand side of this chart, and this shows the returns of different sectors and asset classes over the course of 2022. So you can see there the majority of sectors in the US market producing negative returns, utilities all the way through to communication services. The only sector, in fact, that generated positive returns for investors last year was energy. That's traditional energy. And if we can put that in comparison to other asset classes, gold and US dollar are traditionally safe haven asset classes. So when equities and you see falls in equity markets and risk assets, those assets tend to provide some ballast. Yes, some positive returns, but unless you were in gold, unless you invested in US dollars, and unless you had energy exposure, it's a very, very tough year for investors across the board. So why did this happen? Well, at the start of the year, there was a real shift in expectation of interest rates. And this started before the outbreak of war in Ukraine, but certainly the outbreak of war in Ukraine exacerbated that picture around inflation at a global level remaining higher for longer than what was expected by the markets and by central banks. Now, central banks have one primary tool to tackle inflation, and that's interest rates, increasing the cost of borrowing for individuals and for companies, and therefore using that as a way to taper or temper growth. So because inflation was clearly, well, the assumption was that inflation would remain high for longer, and that change in stance happened very quickly. That then fed through to a change in the expectation of interest rates. So not a change overnight in interest rates, but certainly the market starting to price in many more interest rates than they were expecting previously. Now that clearly changes the prospects for the future cost of borrowing. The big uncertainty last year was there was no real feeling of how significant that change in the cost of borrowing would be, because there was no visibility over how bad inflation would get. Would it remain at more than 10% for an elongated period of time? Would it peak and then fall back? What would the impact of the war in Ukraine be on that? Things like energy, things like commodities, many of which are mined in Russia, suddenly sanctions all over those commodities, many of them mined actually in the Donbass region of Ukraine. Again, how is the access to that? Access to food, all of these really key areas, suddenly prices shooting up and no visibility as to when or that could be tackled. And the other question is, would a change in interest rates even tackle that if that was the goal? So a lot of uncertainty. That was really why equity markets and fixed income markets suffered so much last year, because it was very difficult for investors to have a good understanding of where interest rates, or what's referred to as the terminal rate, would end up. The other factor when you have an change in interest rate expectations, or indeed a change in interest rates, is that investors are able to get a lot more attractive return for taking a lot less risk. And the easiest way of seeing that is, what can you get in a 1-year fixed term deposit here in the UK now? Over 3%. Obviously, that's the first time in many years since the global financial crisis that that's been achievable. Another way of looking at that, and I don't want to get too technical here, is looking at something called the yield curve. So the return on government borrowing at different time periods. And that's what I've got here on the chart. And this really has changed very, very dramatically in the last year and a half. If we were looking or talking in August in 2021, so the year before our last update, the kind of return that you could expect to lend the US government money for 2 years would be zero. You wouldn't get any income return yield on that. If you then lent the US government money now, or the chart here is in November, you could expect a return of around 4.6, 4.7% in terms of the yield. Now that's
a significant change, isn't it, in terms of where we've been for the last 14 years since 2008. And we've had an artificial situation probably for those 14 years, where interest rates have been stubbornly low. Central banks have had very little in their armory to make any changes to that. And it feels in a way that the opportunity has presented itself, knowingly or otherwise, that they've used it as an opportunity to raise interest rates, obviously to try and curb inflation. But in a way, there's an ability to get back to some sort of normality of what we used to see in financial markets maybe 15, 20 years ago. Is that a fair comment, or is that not really the case?
No, I think it's an absolute fair comment. And there's a goal behind getting back to normal, which is the ability, therefore, for the central bank in the US, the Federal Reserve, to be able to stimulate growth as if when the US economy goes through a more challenging economic period. So unless you raise interest rates, and we are on the fastest rate hiking cycle in history, we've seen a considerable number of interest rates at a really breakneck speed, because the central bank's been behind the curve, behind the times. They weren't necessarily keeping as they weren't necessarily just analyzing it and understanding the data in the way that they could or should. And that's a really big statement. And it's not like anyone else was doing it. I don't want to say the US central bank was at odds with the entire rest of the world. I don't think anyone really realized the more sticky impact of inflation. But they have raced to catch up with market expectations and really where the market thinks that interest rates should get to in order to tackle it. But you're exactly right. It then means that they can go back into a bit more of a normal economic cycle, one that we really haven't seen since 2007.
And so the positive I take from that is that whilst it's been a pretty diabolical 12 months, there's probably not much other way of a better way of putting it. I'm hopeful that, assuming we don't have any other out of left field situations, that we get back into a more of a known routine and cycle of investing. And that's surely good from an investing perspective, because you get more clarity, there's more confidence in the market as time goes on. We're obviously not out of the woods, there's a long way to go, but hopefully that makes it a bit easier to understand what might happen going forward.
Yeah, I think we could absolutely say last year was a reset year. Now it was a reset in terms of market returns, and a reset in terms of some maybe quite irresponsible risk-taking behavior from some people that were trading cryptocurrency like it was an ability to print cash. And some of those bubbles have clearly burst. And that's probably a very healthy thing for everyone to realize quite how risky trading, things like Bitcoin or the day trading, that activity that was certainly occurring in a kind of major way in 2021. Now, the real economy impact, I think that reset is still to be seen. And what I mean by that is there's probably a lot of companies out there that aren't necessarily very well run, that have quite a lot of debt on their balance sheet, and have not really had to deal with the consequences of that because interest rates have been really low. They could effectively borrow a lot of money to run their badly run business. And those kinds of companies, I think, will experience a lot of pain. And maybe from a share price perspective, continue to go down. And that's really why, as an investment process, at our investment process, we really scrutinize and really put a lot of emphasis on understanding the quality of our businesses that we have in portfolios, because I think there will be a continued shakeout of sectors and of companies that don't necessarily have fantastic prospects in this new economic environment.
Brilliant, thanks for that.
So how has this fed through to portfolios? Well, you'll probably know that the portfolios really suffered quite considerably last year, and that's really unsurprising given those charts that we saw. If you have equities and bonds down in the region of 20%, which was pretty much the returns that I showed you in slide 1, in a defensive portfolio down half of that, given that that's your investment universe, isn't necessarily, I mean, on an absolute basis, I know that number is very, very hard to stomach. But given the opportunity sets, it's been a fairly successful way of navigating that. I don't want anyone to get hung up or het up on a 1-year performance number. However, we are not investing your capital or a client's capital on a 1-year basis. And actually, if you look over the longer term, this fall that we saw is very much put into context. And this is the track record of the portfolios that we've been running. There have been
Sorry to interrupt. I think the way I look at these charts is, we've been through 2 of the biggest drops in markets that we've seen for a very long time in very, very quick succession. And if we sort of take a more straight line approach across and say, well, where were we pre-COVID and where are we now? We saw an absolutely staggering return and growth out of the back of COVID. And then we've seen a correction over the last 12 months. But to all intents and purposes, those portfolios are still in a better place than they were pre-pandemic. So
yeah, sorry.
I was just gonna say, I think that's a real positive to take from that situation, that we've been through 2 pretty horrific times in very short space of time, when considering the last time was 14 years ago, and actually holding up okay considering the slides you showed at the very beginning.
Yeah, I absolutely agree. And what have we learned from those experiences? Well, we've learned the limitations of globalization. We've learned how important really strong and stable supply chains are. We've learned about economic resilience and security, food security, and lots of these themes are feeding into the types of companies that we hold in sustainable portfolios naturally, because these companies have plans in place to be dealing with supply chain resilience. They certainly are tapping into this idea of alternative energy sources than buying all of your oil and gas from Russia. Indeed, investing locally in well-produced and sustainably grown food as an alternative to shipping all of your agricultural product from across the world plays into the hands of many of the companies in the portfolios. So I completely agree. If you really think about what clients and portfolios have been through over the last few years, it's a very positive story that they've ended up in a good space, and our adventurous portfolio up 40% given those pretty big corrections. But actually the portfolios themselves, I think, are in a very, very strong place because of the dynamics and the awareness around all of these topics, which have just accelerated massively over the last 4 years.
Brilliant.
Interestingly, if we actually look year to date, and again, if I don't criticize myself for looking at short time frames, this is truly the shortest time frame we should ever be considering. And we're looking at just over a month here. There's been quite a big change in terms of stance and approach to the difficulties and the economic challenges that we've been facing, things like inflation, growth, expectations from the market on how companies will react and deal with all of this in the course of the last few weeks. And you can see here a pretty strong rebound. The sustainable adventurous portfolio up 8.5% since the start of the year up until the end of beginning of February, which is a really, really big shift in tone by the markets. So I just wanted to touch upon some of the reasons as to why that's happened. Lots of interesting charts here, really representing the fact that there has been a lot of comfort provided to the market in consistently falling inflation. Now, that's the case in the UK, and we actually saw the data out this morning, which shows inflation continuing to come down. And sorry, it's the 15th of February, so that would have been published this morning. We've seen similar picture happen in Europe, in the US. And this fall in inflation, of course, is the change in prices, and not necessarily prices actually coming down, but the change in prices. That's happened faster than a lot of economists and a lot of market participants, investors expected. So the central bank action here in the UK from the Bank of England, the ECB in Europe, and the Federal Reserve in the US, that increasing in interest rates at quite a fast speed in comparison to history is having a bit of an effect, and potentially that effect was happening faster than the lagged expected effect. So that's sort of good and bad. In some cases, inflation can a fall in inflation can demonstrate a tail off in economic growth, and that's where this concept of a hard landing or a soft landing comes in. Now, a soft landing is where central banks are able to navigate a fall in economic growth and therefore inflation, but manage to navigate not a deep recession. A hard landing is when they're not able to navigate that, and through a very aggressive interest rate rising cycle, usually they push economies into cutting off that growth almost entirely, and then people to stop spending, and then you get more of a recessionary environment. The jury's really been out on how effective the central banks are going to be in navigating this, because they've done quite a fast and hard approach to increasing interest rates, particularly in the US, and that started to feed through. Markets started to become more confident that actually there is this potential navigation of a soft landing, and that's particularly because the jobs data, so that's looking at people entering and being retained in the workforce, those numbers are fairly astonishing, to be honest, in terms of their resilience. What this is showing is people are continuing to enter the jobs market and continue to have pricing power in terms of the wages that they're able to dictate. But the businesses themselves are able to raise prices and continue to keep revenue. So the companies themselves aren't being impacted. More people are entering the jobs market. Economic growth isn't being massively impacted. And so this is sort of the conclusion that the markets have got to, which is the central bank of the US may be able to navigate their way through the economic turbulence ahead and not have to trigger or accidentally or otherwise a recession to get inflation back down. Because it's probably preferable, and the central bank's been quite clear about this, it's probably preferable to take the hit on a shallow recession to tackle inflation than let inflation run away. But there seems to be an indication that potentially both things are happening. And the City of Surprise index there for the Eurozone shows that economic growth being a lot more stable than markets were expecting. And that's obviously in Europe rather than the US, but the picture is very, very similar. And that's very much a surprise. I think most market participants were thinking Europe's probably in a very, very tough situation. They haven't got many ways they can increase in interest rates, because you have different countries together in the same economic bloc facing very different economic situations. Let's think of Greece versus Germany, for example, and navigating that really is additional constraints for the European Central Bank. So the fact that Europe has been a lot more resilient than anyone was expecting has pushed markets higher and given a cause for a bit of a relief, to be honest.
So the fact that we've not officially entered a recession as of today, but obviously when the data comes out, we may have technically moved into a recession marginally once everything's been shaken out a little bit in the UK. It suggests that they are they are walking the line the fine line, and they're balancing just about, it seems, by not tipping us into a recession. Interest rates, I guess, will filter through more this year than they did last year, because we've got a big proportion of people on fixed rate mortgages, for example. And so I think it was something like 1.7 million households or something this year are going to be remortgaging. And obviously they'll be remortgaging at higher interest rates. But we're in this very, very bizarre world that even mortgage rates, a 5-year interest rate on a mortgage is cheaper than a 2-year rate. So that should be a very clear indication that they think that longer term interest rates are coming back down. But certainly short term, they're going to remain high. So the bit you mentioned earlier about some businesses not surviving through this year and there being a bit of a shakeout, do you think that inflation will come down faster as we see more and more households get impacted by the interest rate rises due to their remortgaging?
So the UK is a pretty unique situation in the mortgage market, and it's unique compared to Europe because so many more people here in the UK own properties and have mortgages against their properties versus Europe, where renting is a lot more common. And it's also very different compared to the US, where effectively in the US you get a 30-year mortgage and you can transfer that mortgage from house to house, and if mortgage rates come down for a few thousand US dollars, you can then negotiate down to the better rate. So a lot of people will be fixed for the long term on those extraordinarily low rates. And this idea of your mortgage coming up for renewal in a 2, 5 or 10-year time frame, it just isn't an issue for households in the US. So that's why the Bank of England is a lot more sensitive around raising interest rates at the speed at which they have in the US, and they've gone nowhere near as fast and hard for that reason. And the cost of living crisis being more exacerbated here in the UK because we're importing more energy, we're importing more food. We import 80% of all food that we consume here, which is an extraordinary percentage given the fact that we are still pretty agricultural based in terms of what we produce. But a lot of that goes off out of the UK, and we import a lot of stuff back in. So the chancellors and the Bank of England, chair is obviously very, very aware of all of that and has taken a much more steady and slow path with regards to raising interest rates. But I think you're right. I think the cost of living crisis, which is already pretty tough for lots of people here in the UK, will get harder with regards to the energy cap, and will also get harder as their mortgages come up for renewal. And the recession we have in the UK may well be an isolated UK-based recession for those reasons, that the US is insulated for the reasons I've mentioned, and Europe's actually a lot more resilient from a growth perspective than people realized. And you have a UK isolated recession. So for that reason, we've been very, very selective for quite a long time now on companies in the portfolios that are reliant on a UK consumer, UK manufacturing base because of those challenges. Now, it's obviously not that nice to hear. Most of the people on this call, I imagine, will be UK based. But just for a bit of reassurance, a really extremely small proportion of the overall portfolio is based here in the UK. Even if the companies are listed here in the FTSE 100, they're often getting a massive percentage of their revenues from overseas. So you're not reliant on consumers, and if there is a weakening consumer wallet here in the UK, the impact on the portfolio is not going to be as substantial as one might think.
So going forward, what's the outlook?
So I might just take these slides off now. The outlook is one of, we are cautiously optimistic in terms of thinking of global growth. I think if we'd been speaking this time 4 months ago, a little bit between when we last spoke and now, there was a lot more uncertainty about the effectiveness of central banks in tackling inflation. We've clearly seen a trajectory downwards so far, a real trend downwards in inflation in the UK, well, sort of in the UK, in Europe, in the US, and that's provided markets with a lot more comfort that we're not going to be in an environment where this runaway inflation is not going to be able to be tamed. That being said, we don't want to make the assumption that it's all going to be good news from here on in. and being really selective about the types of companies we want in portfolios, which we are anyway, and I spoke about that, looking for the businesses that have defendable operating margins. So those ones that can pass costs on to their consumers, and those are most often not end consumers, they're businesses in their own right. And the reason they're able to do that is because they have a really good quality product or service. And those businesses want that really good quality product and service at an inflated cost if the cost has gone up to produce that. So being in those businesses that have pricing power, that have what's called an economic moat, that are well run, that can manage the economic uncertainty, that have that resilience base baked in, but also, as you know, that are tapping into these really fast growing and important investment trends of things like climate change, things like biodiversity loss. And these are the areas that governments have been committing enormous amounts of money to. So places like China, places like Europe, places like the US, really passing watershed levels of spending commitments. And these are not net zero type promises where they just close their eyes and hope they can be able to get somewhere by 2050. This is money being allocated to sectors, to businesses, in the form in the US, for example, in tax credits, so incentivizing the companies themselves to be investing in these spaces. And the sustainable portfolios that we run clearly are able to take advantage of a lot of those trends. And if we are going to be facing a recession, and that's a very scary word, it could just be negative growth, very small amounts of negative growth on a global level. One thing is probably pretty clear, it's likely to be a sustainably led recovery out of that. And what do I mean by that? Continued spending by governments in this space, continued spending by businesses in this space. So the companies that have a head start or are operating already in these spheres and in these sectors are going to be very well placed to benefit from that.
So all in all, whilst it has been a pretty torrid year, positives that come from it is that there's been huge amounts of investment into these new areas. It's probably put it on the agenda sooner and faster than it otherwise would have been. And an unintended consequence of the war is that we had to adapt and change. And whilst short-term pain, hopefully that means longer-term gain overall.
Yeah, I mean, obviously it's the anniversary of the war in Ukraine, and it's really appalling to think it's been going on for so long already. But one outcome of it is clearly that it's on the political agenda now to be diversifying away from an energy perspective and a food perspective. So this is no longer a sort of nice to have. And sadly, that the climate crisis wasn't enough for some parts of the world, some politicians, to put it as high up on the agenda as they should have done. But certainly this sort of political impetus has accelerated the focus. And so that has led to, I would say, the ability to get the US green spending agenda through Senate and the House in August. And I do wonder, given that Build Back Better kind of led to nothing really, it got reformulated, repackaged, and there was obviously that political element to it with the war in Ukraine. I do wonder if it would have got passed without that. Who knows? But it definitely has another angle behind a lot of the spending, and it obviously needs to happen.
Brilliant. That's great. Fantastic. Phoebe, thank you ever so much for joining us today. Really appreciate it. And if it's okay, we'll have you back on in a few months' time.
Absolutely fine. Lovely to be here.
Thanks ever so much. Thank you. Bye-bye.